My name is Ron Lake. I'm from Lake Partners. I'll be the moderator for today's event, which is part of the ongoing series of the Greenwich Roundtable, sponsored by Jeffries & Company. I want to thank Steve McMenamin for helping us organize this, and also thank you to Frank Baxter, who's joined us from Los Angeles for today's event. Frank, thank you for being here. We're also very fortunate to have four very savvy and experienced energy investment experts on our panel today. Each of them has traveled a very different path, literally and figuratively, across the energy landscape in the process of developing a particular focus or area of expertise in the field. Our topic today is energy trends, outlook, and innovation. And we're talking about trends, outlook, and innovation for good reasons, which they will discuss. Each of them has also traveled a very different path physically to get here today. Harrison Kaplan, who's sitting two over here, runs Eastgate Management, a diversified equity hedge fund focused on the energy sector. And before starting Eastgate in '95, Harris was part of the management team of Neighbors Industries, which went from being a small land driller to a major international oil field service company. And Harris had to tear himself away from Boone, North Carolina to be here with us today. If you're wondering, Boone is in the heart of the Blue Ridge Mountains, which Harris assures me is the most beautiful place in North America. Bill McCauley, to Harris's left, had to tear himself away from the building across the street to get to the Bruce Museum today. And we all know that that's actually the most beautiful place in North America. Is York Baker here? She knows that's right. Bill is the chairman and CEO of First Reserve Corporation, a preeminent private equity investment firm in the energy sector. Prior to acquiring First Reserve in '83, Bill was co-founder of Meridian Capital, a buyout firm. And before that, Bill was at Oppenheimer as director of finance and president of Oppenheimer Energy Corporation. Andy Fastow, at the end here, is executive vice president and chief financial officer of Enron Corporation. And he's responsible for Enron's finance, treasury, portfolio management, asset syndication activities. And before that, he was at Enron Capital and Trade Resources. And previously was a senior director at Continental Bank's Asset Securitization Group in Chicago. And Andy's traveled here from Houston to be with us today, so thank you very much. Houston, I understand, is much less humid than Greenwich, Connecticut. And last but not least, Willem Quaker, who's sitting here next to me, is chairman of Blenheim Investments, a financial and commodities futures trader based in Somerset, New Jersey. Prior to launching Blenheim, Willem was at Commodities Corp, where he became president. And he's been trading commodities since 1964. Willem just got back from a fishing trip in Sitka, Alaska. The good news is that the fishing was fabulous. He brought back 200 pounds of frozen and smoked fish. The bad news is he left it all at home, so we're going to get the fruit. The other good news is that he's going to start us off with a discussion today of the macro overview of the energy field. That's the good news. The bad news is, though, as he reminded me last night at dinner, he's a futures trader, so normally short term for him means before noon today, intermediate term is close of business tomorrow, and long term means before the end of the month. So on that note, I'll hand it over to Willem for the macro overview. Seriously, listen carefully, because this is someone who's been training in the markets and a perspective based on 35 years of experience. And Willem, I'll give it to you.
Thanks, Ron. It's a pleasure to be here this morning. And Ron asked me last night to start it off, so I'll give it a try. I'd like to go back just a couple of years to put it in perspective, and then kind of lead up to where we are right now. The key change that happened in the energy field was at the meeting in November of '97, when the Saudi minister pushed through a rule that the production of OPEC was going to be increased by 10%. And that was, at the time, it looked like that was the appropriate thing to do. Turned out at the moment that the production was increased, as you all know, beginning of '98 was the beginning of a difficult world economic slide. Various countries, starting with Thailand, subsequently Russia, Latin America, where world demand basically came to a standstill. There's hardly any growth at all. In some countries there was a very serious decline, the most important one being the former Soviet Union. So here came this additional production into a demand status quo, and in some parts of the world basically declining demand picture. So within a fairly short period, we built up a very substantial overload, stocking that was far in excess of what is traditionally traditionally we run at about 85 days to 90 days of world stocks protection, so it's a little shy of 3 months. But the stock picture changed and it went actually in excess of 90 days. And when that happens, you have a very negative impact on prices. And energy being price inelastic, the price impact is magnified. So you had a stock build-up, both showing up in the statistics as well, hidden stock build-up that became very onerous and pushed prices down to incredibly low levels, to single digits again, just like they were in 1980, the Yamani engineered price collapse of 1986. And although several articles appeared at the nadir of the market, particularly in economists, that prices could even go lower yet, the situation, you have to go beyond the pure statistics of fundamental the supply and demand situation and look at the political situation, what the impact is going to be on the producing countries. And politically speaking, single-digit prices have a very devastating effect on most of the producing countries. There are very few countries that can carry on with those kind of prices. And to name a few, of course, the most obvious ones are Venezuela, Nigeria, Indonesia, but also countries like the ones in the Middle East, particularly standing out is Iran and even Saudi Arabia, because it's at single-digit prices like we had at the low point last year. Saudi Arabia ran a budget deficit of about $37 billion, and the situation in Venezuela and in Iran wasn't much different. So the leadership of those countries clearly was looking over the abyss into a very, very serious, as a matter of fact, self-preservation situation. In Nigeria, you have already social upheaval without, even with high prices, you have particularly with low prices. And in Iran, you have a situation whereby you have a large percentage of the population needs to be kept quiet, and that's true in general in a lot of these producing countries, and also in the largest one, Saudi Arabia, because although the price of crude oil is only about $2, $2.50 to be produced in the Middle East, the social cost of a barrel of oil is closer to $13 to $15, meaning that if the price drops, the FOB price drops below $12, $13, you have some significant, potentially some significant social impact. And that's why when the meeting took place at the beginning of this year, the March meeting, they were driven by self-preservation. This was no longer greed that was driving them in some of the previous meetings. And although the market was extraordinarily cynical, that they would hold, that they wouldn't cheat, that they were definitely going to cheat again, and several recommendations were that this was a great rally to sell on, that was a very, very serious mistake, because the willpower to come to a resolution and make prices stick was driven by self-preservation, not by greed like in previous meetings. And that was a key difference. Now, subsequent to that, you have seen that the adherence to the quotas is as high as last month as 91%. And it's my belief that that situation will carry on. You've had some other impacts that outside of OPEC, such as the decline in the non-OPEC situation, whereby, for instance, in the United States alone, we have come down by 500,000 barrels a day. in production. The North Sea isn't growing as fast. If anything, this summer showed like a decline. You've seen decline in production in China. You've seen decline in, well, not decline. You've seen the situation in Russia that is going completely out of control, whereby stocks in Russia itself have been pulled down to an absolute rock bottom minimum, where most of it has been exported because there's a higher price in export than it is domestically. So that has also helped the spot situation. We are now looking at over the next 6 months, if you use the IEA projections, we're looking at a deficit, a daily deficit in the third quarter that is anywhere from 1.2 to 1.5 million barrels a day, and that stands to rise potentially to as high as 2 million to 2.5 million barrels a day in the fourth quarter. And of course carries on in the first quarter, because the fourth quarter and the first quarter traditionally tend to be stock reducing quarters. The second quarter of the year, the one that is concluded, is traditionally a stock building quarter. And but this year only built worldwide for about 100,000 barrels a day, after the first quarter drawdown of about 900,000 barrels a day. So this year, the first 6 months, you had a stock drawdown. This is the first time in a long time. And that, although it's helped, when you look at total world stocks from the end of December till the end of June, we were only in decline by 125 million barrels. So the total rise in prices has been on anticipation of the very tight third, fourth, and first quarter. That's the dilemma that we'll be faced with at the September 22nd meeting. They are right now roughly at the prices where they want the market to be, which is approximately $22 on WTI, approximately $20 to $21 for Brent. And but they are faced with the price that has discounted the future tightening. The market itself is not that tight yet. We had 5.9 billion barrels at the end of December, and we have 5.85 billion barrels at the end of June worldwide. So we haven't really come down all that much in total stock. So they cannot afford yet to raise production. So I am inclined to believe that the September 22nd meeting of OPEC will not raise production. But that leaves potentially the door open for an emergency meeting sometime in the winter, because it is entirely possible that in the Western world, either Europe or in the United States, that you may find yourself suddenly in an extraordinarily tight situation that will only apply to the spot, not of course to the broader situation. But you could find yourself in excess of $22 between now and the end of the year. What is strategically changing as well is that Venezuela, the president of Venezuela, is much more conservative, much more hardcore than previous administrations, and is a strong believer in a strong OPEC. And that has helped, particularly the cooperation between Iran and Saudi Arabia, which is much better than it has ever been in the past. As long as these two were at each other's throat, it meant a weaker OPEC. But right now they are getting along with each other much better. And they're trying to resolve mutual problems, particularly over the islands that they have a fight with Abu Dhabi. And basically they're trying to cooperate in a much stronger OPEC. It is Naimi's, the oil minister of Saudi Arabia's, wish to very much strengthen the muscle of the political muscles as well as strategic muscle of OPEC. And is thinking in terms of a kind of a Tibia-like, cartel-like operation. Now, we all recognize that it's attempted in the past, and things like that in the longer term tend to be fallen well by the wayside. But in the immediate future, meaning in the next year or so, all that talk about working more closely together, the discipline that has been adhered to so far is extraordinarily significant. It's much different than I've ever seen it since in the last 15 years. That's why I think prices are going to stay steady. They are going to. It's a very low probability that we will see prices below $18 again for WTI. It's much more likely that we're going to stay in the $18 to $22 range. And with if OPEC isn't careful, they are being a little overzealous right now as far as the production curtailment is concerned. So you could actually have a little flesh in the pan. But the price will stay steady longer than just over this winter. I think there's a very high probability. That's basically it in a nutshell. So later on, I understand there are questions, so we can come back to this.
Harris, what do you see from your perspective, looking at a variety of segments of the industry on the equity side? What's your view?
Yes, I would say that was a fantastic synopsis in a short period of time of a very complex subject. And I think it was incredibly well done. Thank you. Thanks. Great job. Yeah, I think the question that any energy equity investor says right now is, okay, now what? Valuations, like the commodity price, are anticipating future strong earnings growth. And it's a very difficult time for someone such as myself who I think thought in February, March that we looked to a pretty easy time of upward movement in stock prices. And I think we have to be much more careful right now and look at and see what we think we should do. I think the starting point, though, for any energy equity investor or private equity investor, I would say almost anyone except for Enron, who has done a fabulous job of decoupling commodity price from revenue and profits, and almost uniquely has done so in the industry. The job of anyone is really is to maintain a strong a view of what the commodities are likely to do. So I think because you've done a good job on oil, I don't want to touch too much on that. I think maybe I should talk a little bit about natural gas. And I would just add to the oil side that I would always look to demand as opposed to supply as at the margin where I think the major impact is going to be. And I think it's interesting we're sitting in a room looking at pictures of Korea. I think Korean demand is up year-over-year 12 to 15%. I think demand is really strong for oil. So I would just leave that one thought that when you look at a world which is going to go from roughly 75 plus to 77 plus million barrels according to the IEA in the next 12 months, demand is going to be good, and you'd want to become a leverage to companies on the oil side, but a leverage to demand. On the natural gas side, natural gas, as everyone knows, is a continental commodity because of its transportation issues as opposed to the oil, which is really a global commodity. So I think looking at natural gas, focus on natural gas here in the United States and Canada, I think there the outlook is really pretty strong. It's reflected again in the commodity price, which is at an all-time high for the September contract. And I think it was up. I think we had a 51B only injection of natural gas reported last night by the EGA, which I think overnight the commodity was up again. Demand's up 3 to 4% on a year-on-year basis. Supply's down about 4.5% year-over-year. The rig count, as everyone knows, in North America is at an all-time low. The gas rig count has come back. I think the outlook for natural gas is incredibly strong. We will have gas drilling increasing, but I would be very surprised not to see a strong gas price continuing at least through this winter. And given normal weather, we could have some really interesting shocks to that. One, I'll be interesting to see what Andy has to say at Enron about natural gas, but one of the interesting statistics that we've looked at is production in U.S. fields, and there's this interesting trend and a debate over the issue of depletion. But one of the clear statistics that seems to be showing up is that the second-year production, that's production after a first full 12 months of production from gas wells in North America, the decline rate has gone from 24% to 48% over the last 7 years. I think that's a telling statistic in terms of the impact of technology. I think there's been this kind of this thought that technology is going to enable us to solve all energy problems, all times, and we're going to have cheaper and cheaper energy, especially natural gas, by being better able to find it and produce it more quickly. I think, in fact, what's happening is we're better able to find the oil that's in found reservoirs and get it out of the ground more quickly. And I think that creates behind it a potential interesting problem. And that's why you saw 2 days ago Burlington Resources buy Cocoa in Canada. Because what had to happen was companies which have gone from 12, 13, 14-year reserve lives to 4, 5, 6, 7-year reserve lives are looking out and saying, my business is going away, I better find somebody that can at least get me gas now. And also, the great discoveries, Deepwater Gulf of Mexico, right now look like they're not going to even offset the declines in the shallow water Gulf of Mexico and U.S. land. So, without going into this too much more, I think when we look at the natural gas picture, I think it's every bit as interesting and compelling as oil, and it should present an interesting opportunity. I also completely agree that we're going to see volatility in the commodity market, because once you get up to $20+ Brent oil and over $2.50 natural gas prices, the traders, I think, likely will take incremental data points at that point to be momentum changing, and I think the volatility will be higher, and I think that again will have an impact on equity prices. So I think one wants to be careful. I guess the final comment I would say in that kind of overview and answering your question would be, we look at, we're one who want to put capital in the energy complex on the equity side right now, and there's a bunch of choices. There's energy service, there's E&P companies, there's pipes, there's the major integrated, and then there's new technologies, fuel cell guys, and so on. I think right now, on a risk-reward basis, on a short-term basis, given the volatility, there's some very interesting ideas on the E&P side, particularly in Canada, because I think this kind of cross-border issue, which we saw with Burlington, will continue, and I think there's a bunch of Canadians which are trading at 3.5, 4 times cash flow with historically very good rates of return on capital. So I think that's a very interesting area. I think one wants to be watching the service stocks because of their incredible leverage to volume as opposed to price. And I think that's an interesting area. And I think that the other kind of parts of it, the pipes and the refiners and the integrateds, offer interesting hedging opportunities to balance the portfolio right now. Just one comment on E&P companies, and I was saying this to Andy before about Enron, that the very difficult part about being an energy equity investor on the E&P side is that if you look at any 5, 10, 15, 20, or 25-year period for the 25 biggest or the 25 smallest U.S. E&P companies, what you find is that they've never returned their cost of capital. Basically, it's a business which doesn't work. And so if you're investing in that area, you better be careful to make sure that one's entry point is better and one's exit point is even better. Finally, one last thought. I used to say, when I started at Eastgate when I came out of Neighbors in 95, and I had my first meeting, it was in Tulsa, with a group of old friends from the energy business, and they asked me what I was really scared of, and I said there was two things that I thought were really terrifying if one had a long bias to energy. One was the potential for an Asian collapse, and the reason for that was that at the margin what was happening was that the demand was coming from Asia, and anything that would happen there which would be significant would really severely impact energy. Little did I know. The second thing which terrified me then and still terrifies me is the potential for radical technological change in oil. In American highways every day we burn 9+ million barrels of oil moving motor vehicles in an internal combustion engine, which is essentially the same as it's been for the last 56 years. That is extremely unlikely to stay the same. So as one looks out in energy, even though I would say that in the short term and the medium term, the outlook is really good, and I think the potential as an energy equity investor is really exciting right now. For the much longer time, in terms of looking at valuations, I would always keep one eye on the door for that. Thank you very much.
Bill, you're on the private equity side. What do you say?
Well, actually, what I'd like to do is just reiterate a little bit of what a couple of people said, because it kind of takes in a direction. And I think it's important to remember this is a commodity business. The basis of this business is two underlying commodities, and that is oil and gas. And they are somewhat distinct commodities. And we invest right across the spectrum, okay? For us, energy, probably the least thing we do is oil and gas. We do service, we do manufacturing, we do refineries, we do tankers, we own coal companies. We get out into gas marketing, gas storage, and so on. So it's a broad industry. But most of it comes back to those two commodities. And I had a couple of charts, which you probably can't see, but just to kind of go over what's happened, because I think it's important in the last few years. This is probably what your Saudi minister was looking at back in '97, which was oil demand was starting to steadily grow, and we were going from like 0.5 to 1 to 2 to 2.5%. And that was kind of the outlook in '97 for oil, and that's when everybody was very optimistic about what was going to happen in this business. And then along the way, we got the slowdown in Asia, and we fell off the cliff, and all of a sudden the whole slope of the curve changed. Now, at the same time, and that's oil. At the same time that's going on, our second commodity is gas. And while oil is very important worldwide, gas is very important in North America. And again, if somebody were sitting here in gas, and here it stops in '95, we've got very good growth in gas, only the difference is these numbers are like 3%, 3.5%, 4%, so even higher numbers. And we're sitting looking real good in '95. These two things combine to cause a boom in the stock market and in people's perceptions of our industry. Then what happens to us in gas, and it's not because of a slowdown in Asia, which hits oil, which is an economic thing, because if you think about it, the economy is strong in North America. Among other things, we get 3 years in a row of very warm winters, which on the increment, and this is an incremental business, knocks the curve down, and we get blasted in gas. So to some degree, we had two different sets of events, both of which were looking very good, come together and get clobbered in a period of time, and we go from being up here to being down here. We're now in the recovery stage between those two events. If the worldwide economies hold up, and that's a key, we're going to get back on track for 2% plus oil. And in North America, we're in pretty good shape, and if we ever get some normal, whatever that means, weather, we're going to be back on track and probably pretty short term on gas. So I think we went from here to here, and we're now coming back. In the context of coming back, probably the most important thing, as I said, is what happens in the economies. If the economies stay good, then the industry will be back on track to where we thought it was 2 or 3 years ago. Now, I'm trying to translate that for a second into the two different commodities, and again, they're very different. I think the story really diverges here. In the case of oil, let's remember it's transportation fuel, and as of right now, nobody has an alternative to it. And in the case of gas, your primary electricity in the chemical industries, it's a different set of drivers. Our take is oil is available. We all know it's available. We may get cutbacks, but a lot of the conversation here on oil was not, can we find it? It wasn't, where is it? What's going to happen to it? It was OPEC and political decisions. I think you need to remember that. So I think what that does is it tends to put a cap and puts a floor under the oil prices. And they may drift outside that range, but generally I think you come back to like an $18 to $22 oil price. And I think you've got to expect the commodity to stay there. Gas is a different story because the issue in gas is what does it cost to find it. And unlike oil, it is not an international commodity. It's not that practical except at much higher prices to move gas long distances. So it's a North American commodity, and it's fairly short in North America. So again, two different events going on. Now, turning to some of this more specifics then of the areas, since we've all discussed the macro picture, we prefer gas to oil for the simple reason that the political process in oil versus the shortage situation in gas. We like North American gas, but we also like gas around the world. You're going to get more usage of gas in places like Africa. You're going to get more usage of gas in places like Asia, and there's a whole growth potential in the gas business. We also greatly prefer the service business to the underlying oil and gas business, and the reasons already been touched on. The rates of return stink in the oil and gas business. They're bad, the theory of why, but one observation is that people in the oil and gas exploration business like to drill holes in the ground. It's their background, it's their training, okay, they went to school, they were geologists, they like to find oil and gas. You sit in an oil and gas board meeting, And guys like to pull out maps and talk about how they're going to find the North Slope of Alaska. People get their kicks in the business. That does not make for a good economic basis in the business. So we like the service area a whole lot better. Within the service area, as you probably would check from my comments, we like service companies that play to North American natural gas, for the obvious reasons. And if we do anything in the E&P area, we also are prone towards North American natural gas. In E&P, what that takes you to is it takes you to Canada, because there's more of it up there. It is cheaper to find it. The hang-up they had is they didn't have the pipelines. They've got the pipelines now. And if you're going to go to Canada, you might as well go north and go west. The further you go north, the further you go west, the less has been found. You had problems for 20 years on the Indian lands. You couldn't get into those areas. Those areas are opening up. They're not exploited. That's the direction you go. You also go to the Gulf of Mexico because whatever the technology may be, and a little bit of a different take on the technology, I think we have improved the technology in this business, and we can find the commodity cheaper. I think there were two things going on. One was people figured out, just as they have in industry in general, that there's no point in keeping a 15-year inventory of a commodity. And financial people worked out, just as you all would, that if we can run our inventories down to 8 years, where we can make a lot of money in the process and have a better rate of return on capital. So I think that's been going on at the same time that the technology has been improving. But that has tended to at least temporarily overpower the technology, the financial decision. But now you've gotten it down to a point where the reserve lives in Canada, which the government used to dictate as being 30 years, are now pushing 10 years in a lot of these companies. In the Gulf, you're getting down to 6 years, and there's a limit to how far down you can get those numbers. I think that'll start to stop. And as that starts to stop, then I think you get into a situation where you'll see an uptick, even if demand's not growing all that much, in service activity and the need to maintain that 6 years. Again, thinking about it, you don't have to spend as much money if you're letting yourself go from 15 years to 7 years, finding the commodity every year, as you have to spend when you're at 7 years, and now you've got to completely find the commodity. By finding the commodity, you can't take it out of your inventory anymore. So for that reason, we like the service business. Again, better economics, and number two, this whole event that goes on where you need an increase in service activity just to keep up with where you are, even if you don't have a big increase in prices. So if you want to do E&P, we would say Canada, the Gulf of Mexico, and some of the areas of the Rockies that are gas prone where they finally have pipeline access. If you want to do service, we think it's basically gas service worldwide, North American service even better, Canadian service, and Gulf of Mexico even better, and the water, being in the water. And that's pretty simple, which is, if you go back, and this is hard to believe, but 3,000 feet was a really deep well in the last 5 years. We have built 50-some new pieces of equipment, 40-some new pieces of equipment to go from 3,000 feet to 10,000 feet in the last 3 years. It was like no business deeper than 3,000 feet 5 years ago. So that's a whole emerging play. I think it's good for the oil companies, but you've got to be a good guy to play it, and it's good for the service companies because it's very service intensive. So that's another direction we like. Separately, just touching on a few other areas, coal. Coal's interesting. We've made some pretty good money in coal. I think short-term coal gets very disrupted by utility deregulation. Probably would avoid it for now, but it's probably an interesting play for 5 to 10 years out because coal is primarily electric fuel. That's the use of coal, and that is the use of gas. So if the gas prices go up and the scarcity goes up on gas, it helps the coal business. Another area, some of the other areas we think are interesting. We haven't done much in them, but looking at them, if you think about it, the same drivers that drive what happens on oil and gas prices also impact the refinery cycle, which got aborted. People are getting optimistic about refineries. You're up to high utilization. the refining business. Well, the same fact of demand going down impacts refineries. So at some point in time, you're probably going to get pretty tight on the refining cycle. Same thing happens to tankers. Same thing happens to transport. The tanker business fell off the cliff. The business is really down, and same reason. If you don't have the oil to move, then you're in a situation where you've got surplus capacity. What's wrong with the tanker industry is that every time it turns down, and again, it's the same phenomenon. You know, guys, no offense to anybody in the room, guys that own boats like to get a bigger boat, and they like to put more stuff on their boat. Okay, I'm not the only one. Guys that own tankers like to own tankers, okay, and they like to own a bigger tanker. And they tend to go out there and they tend to build tankers. So these cycles don't last so long. So I think there's some short plays in those businesses. But anyway, I want to keep on going. Kind of summing up, we like the outlook for the business, in particular the service business, and in particular because we don't think you can keep using the inventory situation to replace your underlying business.
Bill, thank you very much. Andy, what's happening at Enron? You guys are actually involved in this stuff.
Okay. First of all, I appreciate all the comments from the speakers. I found them very interesting. But I think I was invited here primarily to antagonize the other panelists. Probably some people in the room, although they've been very kind with their comments about Enron. But my comments will be a little different because Enron is both an investor and an issuer in the energy industry. Let me tell you what I mean by an investor. Enron, as a principal in the industry, invested about $7.5 billion last year in new energy investments. Year to date this year, we've invested about $3.6 billion and probably on track for about $7 billion range again. And I'll talk a little bit later about what I mean by investing in the industry. But before I do that, I'd like to talk about definition of the energy industry itself, because when the folks at Jefferies invited me to be here, they wanted me to talk about issues and outlooks and innovation in the energy industry, and I thought that was interesting because they didn't say what the energy industry was. And I think probably, based on the comments of the other panelists and judging by the limited interaction I've had with some of the folks in this room, it's most people here define it as an E&P industry, as oil, maybe oil and gas. At Enron, we don't define the energy industry that way, and I think increasingly as investors have to think about what you mean by the energy industry, what you mean by the sector you're in, what you mean by the model of the business you're in. Do you want to be in a vertically integrated business? Do you want to be in a networked business? Do you want to be in a business subject to commodity price swings and the like? And I'll talk a little bit about those. Primarily what I'm going to focus on, what I define as energy industry at Enron, is natural gas and electricity together as one industry. They can't be separated any longer. If you put natural gas and electricity together, this is the largest industry in the world today, both in terms of capital investment and in terms of revenue. It dwarfs the integrated oil industry, if you look at it around the world. I'd say that in the E&P sector as investors, you're big investors. If you look at the opportunity in natural gas and electricity around the world, given the magnitude of the market, you're small investors. So that'll mean something different going forward for you as investors. There's a completely new set of risks to manage in natural gas and electricity today versus 5 years ago or 10 years ago. I'll talk a little bit about those. And there is a massive revaluation of assets going on in the natural gas and electric industry today. And that will continue over the next 5 to 10 years, not only in North America but around the world. There are two trends that are causing this change in the natural gas and electric industry, which in the past you probably just called the utility industry, or the utility sector, or the project finance sector. I wouldn't call it that anymore. I'd call it more a convergence industry or gas and electric, because it's not project finance like it used to be, and it certainly isn't a utility anymore. And all you have to do is look at the returns or performance of utility bonds, for example, over the last 3 to 4 years, and you'll see a utility isn't your safe bet any longer. Real quickly, just background on Enron to give you my perspective of where I'm coming from. We are the largest integrated natural gas and electric company in the world today. We're more an electric company than we are a gas company. We sold more electricity last year than we sold natural gas. I don't think people realize that. Just to put that in perspective, Enron sold 400 million megawatts of electricity in the United States last year. That's about twice the size of Southern, which is the largest utility in the U.S. We've got $30 billion in assets on our balance sheet, $51 billion in assets total. And I want to come back and talk about that because that's really a key for you as alternative investors in looking for ways to deal with large companies in this sector that might be throwing off opportunities for you. Since 1990, I'd say largely due to the deregulation and privatization that have been occurring around the world in gas and electricity, Enron's market cap has grown from about $3.5 billion to $35 billion. And I'd say that in addition to being a preeminent gas and electric company in North America, we also now have a preeminent position in Europe. We're the largest seller of electricity in Scandinavia. We'll be number one in the UK by the end of the year, number two gas player in the UK by the end of the year. In South America, we have a leading network. We have the best network of assets to begin marketing gas and electricity. And in Australia, we should be the largest seller of electricity by the end of the year as well. So on a global basis, these two trends, deregulation and privatization, are giving rise to the opportunity for companies like Enron, which are more merchant companies, buying and selling commodity to make a play. Let me tell you what we're not, because I think it's important relative to the other comments. We're not a bet on commodity, and I think Harris summed it up best. We've decoupled ourselves from commodity. I'll tell you, I don't want to wake up every morning and wonder what the price of oil is or the price of natural gas or electricity is. If you thought oil was a tough bet, when gas started trading on the NYMEX in, 1992, I think, Harris, is that right? It became immediately the most volatile commodity in the world in terms of price. When electricity started trading, it dwarfed natural gas. Let me give you a data point on this. Last year, we had a heat wave in the Midwest. You may remember the El Nino heat wave. A couple of nukes went down. A few things happened. The price of electricity per kilowatt went from an average of between $30 and $40 to $10,000. Okay? Put that in perspective. What if the bond market did that? The entire world would collapse. So the volatility in these commodities, natural gas and electricity, are far greater even than the volatility you see in oil, which is already impossible for you to manage. So how do you play in this sector? Our business at Enron, the best way to describe it in one sentence is, we're not a commodity play. Our business is to intermediate risk between the buyers and the sellers of these commodities, the physical risks and the financial risks. We're the settlement system. We make the market, if you will. The physical settlement system, and we're the financial forward market. And we provide the services to help other companies manage the risks associated with those commodities. So it doesn't matter to us whether the price of oil or gas or electricity goes up and down. We just want it to go up and down because we make money with volatility, because then people pay to hedge those risks and the price of hedging that risk goes up. That's the business we're in, and as long as those commodities continue to be deregulated and have volatility, which they will, Enron will continue to grow around the world. Okay, now I'm going to break the rest of my comments into two sectors, two parts, the investor perspective, which we have at Enron, and then the issuer perspective I have at Enron. And they don't always fit together, which is part of the reason for forums like this, is there are clearly gaps between the two. But I would agree with another comment Harris made. First, from an investor perspective, investors have never earned a compensatory rate of return investing in oil or gas in the past. Any analysis you do, I think Harris said they haven't even earned their cost of capital. That's probably true as well, but everything we show is you could be the smartest investor in the world, and I think we have some of the smartest energy investors in the world on the panel today, and their record clearly shows it. They've earned great nominal rates of return, but I'd argue that if you risk adjust for all the risks in the E&P sector, you've never earned a compensatory rate of return there, even if you're the best at doing it. And it's as simple as this. You could find a new technology to pull oil out of the ground. You could go from 3,000 to 10,000 feet. You could find how to build the next big super tanker to lower your transportation costs. You could do all the right things technically. You could find the gas in the ground just where you thought you were going to find it, or the oil. And if the price is down, you lose. It doesn't matter. And so you've got a commodity play, even if you're right on everything else. My personal view on that is, if you want a commodity play, bet in the futures market. You could lever yourself a whole lot better in the futures market, and if you happen to bet right, you'll make a whole lot more money. And if you bet wrong, you're going to lose money anyway. Having said that, Enron had been in the E&P business a long time. We just sold our E&P business. In fact, it closed on Monday. We floated it out to the public. And they wanted to buy it, and that was fine. Okay. The reason that I'm able to say something, make a comment like investors have never earned a compensatory rate of return, is because we have new tools available, and I've touched on those tools to enable us to be able to price those risks and evaluate those risks. And most notably, that has been the development of the forward market for the price of gas in particular, and now electricity in the United States. You can disaggregate any energy investment today into each of its constituent risks and price those risks individually. Okay, so when you look at any type of energy investment, historically investors have had to look at those as one bundle and try to figure out, how do I evaluate this bundle of risks? It isn't that way anymore. You could segregate out the price risk, the geological risk, the production risk, the transportation risk, the interest rate risk. Every single risk can be disaggregated. You could look today at an energy investment like a financial investment, and each of those risks can be segregated out and traded separately. And if you do that, that's how you conclude that historically you haven't been compensated fairly for your investments in the sector. It's a tool that I think, regardless of where you invest, regardless of how you define energy going forward, it's a tool that people in this room are going to have to use more and more, figure out where they can price those discrete risks, and in fact maybe trade those or hedge those discrete risks as appropriate to manage their portfolio. I think when you look for companies that are investing in the industry, or if you're investing and looking for those tools, you have to look for 4 tools that a company has to have. First of all, you have to have a company that has what I call commodity risk management, the ability to transact in physical commodity. Okay. Second, you have to have a company that has to be that is capable of transacting in the financial commodity, or that is making a forward market in the price risk for the underlying commodity. Third is, the company needs to have an asset development, construction, and operation capability. And fourth, it has to have capital to be able to invest in those assets alongside with you. You don't want to be the only investor. If the energy company is not investing, it's probably not a good investment, because they could price those risks more efficiently than you could price those risks. Okay, now why do you need physical and financial capability to operate in the gas and electric industry, but you don't necessarily need physical capability to be, say, a financial trader in the oil industry and maybe do very well? And the difference has been touched upon by some of the other panelists. Gas and electricity are physically constrained by a grid. Okay? Whether you're in North America is one market, but that's a completely discrete market from Europe, let's say, which has its own integrated gas and electric grid. So you have to understand, if you're going to play in this market, how the gas and electricity move through the grid, where the stress points are in the grid, because you have to understand not just the price of electricity. You have to understand the price of electricity in New York versus Virginia versus California versus Chicago all at the same time, and how those play with each other, and how the price of gas is moving relative to the electric industry as well. So it's a little more complicated. My advice, or what we look for as an investor, is those 4 capabilities, or bringing those 4 capabilities to the table to manage the risks in this bundle or investment. And I'll be happy to go into that in a little more detail if people want me to. The best way to describe that model is it's a network model. It's not a vertically integrated model. I think people tend to think of either E&P sector, their producers, or the big oil company, big vertically integrated companies. We're not talking about that. When you think of North America as a grid, it's a network model. Okay, so at Enron, we don't think, let's say we're selling gas to someone in Chicago. We don't think about where we can produce that gas and then how to move it to Chicago. We think about where can we source the most efficient gas that's being produced by perhaps someone else and move that to Chicago. Okay. So it's a network model where you're looking at portfolios of supplies and portfolios of markets, and you're figuring out how to best match up your portfolio of supplies and markets. It's like financial. It's like a financial portfolio. The bigger and more diversified your portfolios are, the more of a structural cost advantage you'll have, i.e., the greater ability you have to absorb risk into your portfolio relative to your competition. Okay, that's my investor perspective. My issuer perspective, and this is a little better news. I didn't mean by all of my comments today to scare everyone away from investing in what I describe as the energy industry. Quite the contrary. I think the interesting thing is that right now I describe the industry as the largest industry in the world and also the most capital-intensive industry in the world. So the companies that are able to play on a global scope relative to the operation, relative to the opportunity, have anemic balance sheets, and they need capital to invest. They need capital, and I'll describe how they'd invest their capital if people would like me to a little more. But they need capital to invest, to take advantage of these opportunities, and the companies that could get in there today and invest the capital and bring those four capabilities to bear to manage the risks in that investment are reaping massive rates of return and massive risk-adjusted rates of return as well, simply because there's so many opportunities and so few companies with capital to do it, take advantage of those. So that's an opportunity for investors, I think, straight away. The other challenge is if you look at as a company like Enron, we're again a 30 or $50 billion company, however you describe it. That's a big company. We have $40 billion in revenues. We're Fortune 50 U.S. We're still anemic. We're a triple B rated company. We can't continue to gear our balance sheet to grow. We need capital. The problem in the energy industry, and the reason we don't just issue equity to grow at Enron, is that typically when you invest in energy-related assets, gas and electric-related assets, there tends to be a 1 to 3 year lag before you see earnings and cash flow coming out of those assets. So if you're a public company, you can't issue equity because in the short term you're going to dilute your shareholders and crush your stock price. So what you have to do is find alternative ways to raise equity. And so at Enron we do three things, and I think you'll see other companies, and I'm sure you're seeing them already, but you'll continue to see these gas and electricity, large gas and electric companies that appear to have great access to public capital increasingly come to the alternative investment market to seek private equity capital because they can't issue the public equity because it'll dilute their shareholders in the near term. They can't lever because they're already under pressure from credit rating agencies. Companies like Enron or Triple B, companies like utilities will continue to see downward pressure on their rating because of the volatility that they're seeing in their markets now. It used to be real easy to predict the utility. Now it's extremely difficult to predict the utility. So they're going to do two things, I think. The first is you're going to see just a tremendous number of individual investment opportunities, independent power projects. I imagine people in this room are already seeing books and books showing how great new independent peaker facilities in the United States are, and they're evaluating those transactions. You'll continue to see those, and the numbers will grow over the next 2 to 3 years. The second thing you're going to see, and the second way we raise private equity capital at Enron, is through our own managed funds, if you will, where we form really what are best described as co-investment funds, where Enron would invest, say, half the capital in an investment, and we'd have a group of private equity investors, typically pension funds and endowments, that would be investing alongside of us, but looking to Enron, if you will, to manage those assets and be required to manage those assets and stay invested in those assets. So basically looking to directly align the economic interests of institutional investors with a public corporation in specific portfolios of investments. So I think you'll continue to see those as well. Overall, I think it's a great worldwide opportunity right now for energy investors. But I think the most important thing that energy investors should be thinking of going forward is that now they have the tools to manage risks that they didn't have the tools to manage before, and they should be looking to bring those risks to bear as they make the energy investments. I think if they do that in the right sectors, they're going to see great risk-adjusted compensatory rates of return. Thanks.
Andy, thank you very much.
Several research reports have come out describing today's environment in two different ways. One is we've had just a disruption in a recovery that had started several years ago, and another is sort of, a new paradigm type of thing. Could each of you address macro cases?
You're talking specifically about the oil and gas markets.
Yeah.
I'll just take one stab at one thing on the oil side. We talked before about demand, and one would have to look at supply-demand fundamentals on the longer term to answer the question, I think. In 1986, the last time that oil prices collapsed to the levels that they did in this past year, we were consuming about 65 million barrels of oil a day, 64, 65, and there was about 14 or 15 million barrels of excess productive capacity in the world. That's a problem. Right now, we're going to consume next year about 77 million barrels of oil, and our excess productive capacity, 3-4 million barrels of oil a day. So what's happened is we're getting closer and closer to a just-in-time on the oil market side, just-in-time inventory system. That's a little scary. And that probably bodes well on a longer term for the answer to that question being that it was a blip based on a demand crisis in Asia, weather-related, and an incremental 2 million barrels out of the Jakarta meeting in 97 and anything else. I think, as Mr. McCauley said on the natural gas side, I think that the fundamentals there are very clear, that we have a strong growth in demand, which is a secular longer-term growth. I think electrical generation is going to be a significant factor. I think it's on an order of 4-fold increase in daily natural gas demand coming out of electrical utility growth over the next 10 years. 4-fold growth. And at the same time, we're having a lot of trouble replacing the gas that we've been drilling. I was going to say my favorite statistic of this is in 1997, we drilled twice as many natural gas wells as 1995 to produce the same amount of natural gas. In 1997, we drilled twice as many wells as we did in 1995 to produce the same amount of natural gas. Growing demand, difficulty with production. I think we're in the middle of a longer-term phase with a lot of disruptions in the middle.
Any comments?
Yeah, I would largely concur with that. As a matter of fact, the fear that still exists today after the collapse that we've seen the second time in a little over a decade, it's a tremendous reluctance to sink a lot of money in new oil wells. And you see it in this country, the prime example. I told you earlier that we declined 500,000 barrels a day. We're down to 5.8, 5.9 million barrels domestically. Alaska is down to a little over 1 million barrels a day. And you see the same thing in the North Sea. So there is a reluctance to invest right now into new production facilities. The demand outlook, and we saw the turning point in the beginning of this year when OPEC, prior to its cut in March, you saw already that incremental demand in the Far East was beginning to pick up. We track the movement of oil very carefully, and so when you see that most of your oil, or an incremental percentage of your oil start moving from the west to the east, that means that industrial production is about to change in that particular area of the world because there's a very high correlation between energy demand and industrial production in the country. So, subsequent to that, you've seen tremendous increases percentage-wise in countries like Korea, the Philippines, and even Thailand. So the demand outlook for the first quarter of next year, the call on OPEC, is indicated by the IEA as 30.3 million barrels, which is, considering they're now producing 26.1, including Iraq, that's a 4 million barrel a day increase projected right now. Spare capacity is between 4 and 5, and that's that. So you see a delay in new exploration, particularly in the non-OPEC area. Clearly there is more oil available in OPEC, but at a price. And it's the time difference, the time sequence that's so important, which is why I think you could have an extraordinarily tight situation. If demand indeed is going to continue to grow as it is currently projected, never mind it gets even better than that, you could see in the world energy quite a significant impact on prices. And domestically, natural gas, we are somewhat in the same boat. So you could see the two combined in the winter. After all, we also had 3 winters that were pretty benign. You get a cold winter in the northern hemisphere. Then, Now, is this a flash and burn? I think the drop in demand last year, that clearly was as a result of the collapse. But otherwise, you should continue to see, on average, between 1.5 and 2.5 million barrels a day equivalent annual increase in energy demand. So we need to sink a lot more money into exploration and build up that excess capacity.
I just add that I don't disagree with anything, any of the comments that were just made. But on a personal level, I get no bonus if I guess how the Saudi oil ministers are going to act, and I don't want to personally be betting that they're going to act rationally versus irrationally to preserve themselves. I don't get a bonus if I guess what the weather in Chicago is going to be next summer relative to the norm, and I get a bonus if, despite all those things, my investment portfolio performs exactly as expected. And I think that's the difference between Enron and many of the other energy companies that you look at in the market today.
And Willem gets the bonus you don't get for guessing all those.
That's right. He has a much nicer suit than I do. I see that as well.
I have a question on credit derivatives. It's a relatively new market in energy, and I understand Enron is one of the bigger users. Could you discuss that market, what you think the risks are, how much is pricing and paperwork, and whether we could, here on Wall Street, see a blow-up? I know it's a hot area now.
What do you mean by blow-up? I'm sorry.
Well,
Is that a good blow-up or a bad blow-up?
You tell me.
Well, just credit derivatives are another tool to help manage risk, and I think we've seen growth in that market that's been tremendous over the last couple of years. If you think about, if you kind of dissect Enron's businesses and think about it, I keep belaboring the point, we're not taking commodity price risk. But yet we're the largest seller of natural gas, the largest seller of electricity. So what risks do we have in the company? What we really have is big portfolios of supply contracts with companies. We're not the biggest producer of gas or electricity in the country, but we're the biggest buyer of gas and electricity in the country. So we have contracts with all the sellers. So we take their counterparty credit risk and they take ours. And the same thing on the sales side, on the market side. So we have huge portfolios of counterparty credit risk. What we have to do is manage that counterparty credit risk. So we look for lots of different tools to do that. But that's the ultimate risk that we have at Enron, is counterparty credit risk.
Is that off-balance sheet risk?
No, that's on our balance sheet, and we have reserves for that. We treat that like a bank would treat counterparty credit risk, and have the same type of credit scoring system. The agencies come in and look at our portfolio of risk. Over 90% of our counterparty credit risk is investment grade.
Is documentation standard in that business, or is that?
I'd say it's large, certainly for any contract business you do, but sometimes you'll also make investments that expose you to counterparty credit risk. So if you're in an investment, that may be a very structured deal. And again, you have to strip out the counterparty credit risk, make sure that gets into your credit book, if you will, and gets managed along with the other counterparty credit risk. So for the most part, yes, it's standardized, but not always.
Could a blow-up start, somebody having a problem, affect other people just because of the counterparty risk?
Sure. I mean, you have to look at, and you saw that last year in the Midwest. What's the name of the company? There was one power trader that. Sorry? Yeah, Power Corp. In fact, they had their office up here, didn't they? Anyway, it was a couple of guys with no capital to speak of behind them. They're entering into very long-term, highly complex options with some very smart, big U.S. utilities. And as soon as the market went from, remember my reference, from $30 to $10,000, they couldn't deliver and they couldn't perform financially under those contracts, so they basically filed bankruptcy, and that caused losses at the other utilities that were counterparty to Power Corp of America. So if you're in this business, you better understand who your counterparties are and have a rigorous credit system that can assess counterparty credit risk and then manage the counterparty credit risk. And you have that portfolio. You own a portfolio of counterparty credit risk. You've got interest rate risk in there. You have credit spread risk in there. And as those markets move, you ought to be recalculating what your real value is in those contracts. As credit spreads gap out, a company's really losing money in this business. They may not be recording it financially, but they're exposed to it, and they will ultimately record that if the credit spreads don't come back in.
Thank you.
Sure.
I have a question about last week's Synergy force majeure some electricity in the Midwest.
Mm-hmm.
What's your take on that? As the largest utility in the Midwest, they're putting the force majeure because they couldn't get their hands on it.
I think I'm not an expert and I don't have all the details, but my understanding is that they've now come back and said they're going to perform under all of those contracts and make financial payments. That's right. I mean, it's like the oil market. I think there's about 7 times the amount of oil financially traded as there is physically traded in the world. That's like saying because you couldn't find oil, you can't settle under your forward contract for oil, and that was I think an indefensible position. So they are, is my understanding, performing, and the articles I read in the paper indicate that they're going to have to take a write-off of $70+ million, if I recall correctly, to account for those losses.
Did that affect the flow of electricity at all? Did people not receive it because, besides the financial part of it, did the actual molecules not flow?
Well, there are only so many electrons on the wire, and in that case, there weren't enough electrons on the wire. Now, it doesn't mean that you can't find electrons, and if someone's receiving electrons or about to receive electrons, you can certainly buy those electrons for someone. There's a price that a company will receive and be willing to receive not to receive electrons, and in essence, that's a market. So there's a constrained grid with a limited capacity, but there's always a market for those electrons, if you will. And Synergy's problem was they could have gone out, to their customers they couldn't deliver to. Basically, they should have just said, well, instead of delivering them, we'll buy them back from you before we deliver them. That's a transaction. That's a buy and sell. And their problem was they were short electrons in their price book. It doesn't matter what the physical price of electron is if you've hedged the price in your forward book, if you will. They were short. They don't run a matched book, is what they said. Or they didn't know they were not running a matched book, which may have been the case. I don't want to speak for them or say anything inappropriate. We run a book at Enron where we hedge our price risk. So, for example, at any point in time, our gross position's never greater than 1% of our net position. Net position's never greater than 1% gross. And on a term basis, we're very well matched as well. So you could run any scenario, and we know just how much, any price scenario. And the reality is we didn't have to take, unexpected write-offs when the power price jumped from $30 to $10,000.
We don't get a comment, risk.
I'd like to insert one caveat here when it comes to risk. Andy didn't touch on it yet, but over the years, I've seen it happen time and again. And I've seen it even in so-called market neutral positions, and balanced book, and hardly any net position, and all that stuff. Because the more one hears that, incidentally, one has to be a lot more careful. And by that I mean it's the risk of size. I've seen time and again in commodity markets, because a market, in my judgment, is like a jungle. It's survival of the fittest. And if somebody gets too big in that jungle, all the little animals that scurry around this guy are going to attack him. And that's the risk of size. And prime examples in the last few years have been the copper situation, the Hamanaka Sumitomo affair, which is simply too big for the market. We've seen it, Metallgesellschaft, the subsidiary of Deutsche Bank, that ran a spread book, no risk net, and basically went belly up and cost Deutsche Bank a lot of money. And all that, and of course long-term capital management is a prime example. It's the risk of size. If you become too big in a market, and I don't care what the market is, eventually the market will get back at that individual, that company, because it doesn't fit in the parameters of the model that you build. Now, the model goes by that everything is ideal, and it's based on history. After all, it's the future that we're looking at. And so one tends to overlook, and not because one does that on purpose, incidentally, because most of the time we don't know that you are slowly becoming the biggest animal in the jungle. And until somebody starts snapping at your heels, and then it's too late. So the risk of size is a very important risk.
I would agree with that. I think that's important. I just amplify that by saying, if you're too big, you lose too much liquidity in the market as well. Other people can't be counterparties with you because their ability to price risk relative to your ability to price risk becomes too disproportionate. I'd add one other point there, which is I think in many of the cases where you've seen companies blow up or have unexpected losses, like MG, has been when the companies have, in my opinion, reported their financials in an inappropriate way for the business they're in. And basically this is the difference between accrual accounting and mark-to-market accounting. In my opinion, any company that is in the business of trading a commodity, or being in the marketing business or exposing themselves to commodities, ought to be mark-to-market their entire book and reporting those on a current basis. And what you see in the market most of the time, with utilities in particular, is accrual accounting. So you do not know what's in that book. You do not know if, in fact, they've got a big spread on like Metallgesellschaft or not. And that's why Synergy announces a write-off. For example, that was a write-off. That wasn't a mark-to-market position. Enron marks to market all of their books. So if there were exposures in these environments where you see volatility going from 30 to 10,000, you'd see that affecting our P&L immediately. That's not to say there is no risk in the Enron system. I'm not suggesting that. But I think when you're looking at investments or companies, make sure you think about the accounting methodology used. Because Will has a very good point.
Are there energy technology or IT system areas that could have an important impact on either the generation area or transportation or systems management that can have an important impact on some of the energy investment opportunities you look at? I'm thinking more on the demand and that side of the market. I mean, fuel cells would be an example. Or hybrid vehicles. I mean, whatever could impact.
We're spending. I think the answer is there's going to be enormous impact, and we're spending quite a bit of time looking at those technologies. I mean, it's a difficulty as any other technology investment, except in this area, in this case, because it doesn't have .com at the end. You don't get the benefit of the multiples and the glory of investing in that. But there's absolutely new technologies being developed, and we actually have a person who's spending most of his time doing it.
Yes, there are. They've been around for a very long time, most of them. It always seems that if the oil price were $4 a barrel higher, they would now be economic. That has seemed to have been the case in the 30 years I've been in the business, no matter what the oil price is. Now, that's not to scorn it, and we look also, okay, but really have not found anything to date. Now, on the other side of the equation, which you didn't ask about, there really are some technologies in finding oil and gas. We invested in a small company here in Connecticut that comes out of United Technologies that's in the fiber optics business and is attempting to develop products where they can put call it the equivalent of home cable down an oil well, and then be able to measure things off that cable system with sensors, and be able to measure multiple things, including doing 4D seismic, for example. And what they'll do is rent the cable to various service providers, and much more sensitive sensing devices than we have now. That is potentially pretty significant. Another one of our companies, National Oil Well, we've put in a and we're the largest manufacturer and provider of equipment for rigs and servicing rigs and so on. We've put in systems which, while they're not rocket science in a lot of other industries, but put in systems where we can measure for a neighbor, say, which we're doing, what their usage is, what their demand is for their rigs nationwide, and greatly improve the distribution and greatly improve the efficiency of the rigs and improve the purchasing and so on. So there are things that are going on that side of the business that will make a difference and will make the business more efficient.
Yeah, Harris, can you elaborate on what you call new technologies, the fuel cell situation? Are you talking about a Ballard power, and can you name some names like that? Or?
I don't think I'm at a point where the only one that we've had an investment is the Valley Power. So I guess I could name that name. The others, I don't think we've done enough modeling work to be able to be intelligent on the point. I'd be happy to. Please call me, and it's an ongoing process for us. I completely agree with what Mr. McCauley said about, it always looks like it's down the road. I guess I come from that terror school of investment more than the greed school of investment. So I don't know that it hasn't happened means that it will not happen in short order, and I think there's a bunch of interesting technology. But it's also really true that the ability to find oil and gas has worked to the benefit of the industry. It's done a good job of pushing it out. I think it's more of a dialogue and an ongoing process, and I'd be happy to kind of talk about it any time. Please feel free to call me. And I could put you in touch with the guy who's actually doing kind of the real grunt work in terms of going, seeing them, and running the stuff.
Anybody else?
Can maybe the panel address, we talked about different scenarios, but I guess it's addressed a little bit some of the maybe non-traditional investment ideas. I don't think the company so much, but just ways to play the energy market today that may be risk appropriate if anybody on the non-traditional side has some thoughts on that.
What do you mean by non-traditional?
Not buying shares. There are other ways to play it, I guess. What is playing the futures market? There are other ways to do it other than buying shares in stocks and bonds.
Well, in the futures market, of course, besides the directional transaction, which is the most obvious one, you have the oil is unique in the commodity world in that it has tremendous interplay between the commodities that are derived from value. And unlike natural gas, the arbitrage possibilities also, whereby you trade one continent against another. The Brent WTI spread, for instance, is a sizable moving spread, and some people do trade that very, very actively in substantial quantities. But the most obvious one that you can trade in size are the so-called crack spreads and the time spreads. And the time spreads are simply trading, one quarter against another quarter. Like for instance, trading the fourth quarter against the second quarter next year. That spread has gone from approximately a $3 discount to a $1.25 premium. So that in itself is a $4 move on a spread, which is a market neutral play. But it's a significant, and you can trade it in substantial quantities. Once the market becomes inverted, which I think is going to happen, it has already happened, but on the spot position. And that's incidentally the Goldman Sachs commodity model was based on that originally, where you can roll the premium against the forward discount and you keep doing that till the cows come home and take the money. Of course, that only works for so long, and then it goes back to the discount. But it's the time spreads, it's a significant play. Then, of course, you have the crack spreads. Crack spreads are going to be interesting. When you come out of a period of surplus crude oil, and the surplus moves from crude oil down the chain eventually into surplus of products. Then when OPEC tightens the reins, it's the crude oil market that tightens it first, and that results initially into a narrowing of the crack spreads. You saw that happen. The narrowing when, where the refineries actually had to cut back in production because of a negative crack margin. That's the normal sequence. But then the deficit starts moving into the product markets, and then the crack spreads start widening, till eventually you get to the point whereby OPEC turns on the crude valves, and now the crude becomes ample, the tightness is still on the commodities, so you have widening of the crack spreads until the surplus moves back into the products, and you have narrowing of the crack spreads. Those are very beautiful cyclical moves that you can play. And again, and then of course in the summer you have the weather factor in the gasoline market, and in the winter you have the weather factor in terms of the heating oil contracts. You have arbitrage opportunities, as I said, between WTI and Brent. Arbitrage opportunity between gas oil in Europe and heating oil in the United States. So, and all those markets move percentage-wise fairly significantly and are highly liquid. And that's another way of incrementally adding a fairly substantial rate of return to your outright play. They're not riskless, those spreads, don't get me wrong. Although they are market neutral, so to speak.
If there are no other comments, let me just pass over to Steve for a few announcements.
Thanks, Ron. I'd like to welcome a few colleagues from out of town. Nick Carey from Eastern Investments, and Jim Chapman, Regiment Capital, coming out of Harvard, former new hedge fund. I'd like to thank my colleagues coming in from New Orleans, Danny Conwell, Jay Courage for helping us put the panel together, and David Fishborn for thinking of this whole thing. Thank you, gentlemen. And finally, I'd like to say that today is Ron's birthday. Let's embarrass him.
27.
Here it's Bill Clinton. Bill Clinton, maybe kind of the route that we were looking for a house.
That's right. Well, thank you, Steve. And let me also especially thank our four panelists for joining us today. They come from very many corners of the energy world and the U.S. So again, thank you very much. Thank you for your insights on the trends, outlook, and innovations occurring in energy. And our next panel is on September 23. The topic will be global asset allocation. Our speakers are Marty Zweig, Raj Gupta from Lee Cooperman Shop, and Eric Fry, who is publisher of Grants International. So hope to see you then. Thank you.